Hello, everyone. This is Dr. Duru from Ahan Analytics with the market breadth. All right. It was Fed week. That was the pivotal news, but we had, of course, a lot of other stuff going on. I will cover some of it alongside the technicals of the stock market. What you're looking at here is Swing Trade Bot. It's my favorite stock scanning tool. As I always mention, I am a subscriber, so some of the things I show in here you may not be able to see if you're not subscribed. What I wanted to start off with is this index trend table tells you everything you need to know about just how strong the momentum is in this stock market. All of the trends on all of the major indices are up, 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 and almost all of the signals, technical signals, are bullish. But there are some, as always, there's always some but ifs or but ands in these kinds of assessments, that everything can't be 100% rosy. And so, what I wanted to point out is that while new highs definitely dominated new lows, which we would expect in a strong market, we have bearish signals far outnumbering bullish signals. Even more importantly, the advancers, 3,715, well dominated the advancers 2021. So I'm a little cautious. And as you can imagine, the combination of this, of the bullish versus bearish signal imbalance and the advancer and decliner signal imbalance suggests that, sure enough, market breadth disappointed on Friday. Um, my favorite technical indicator, the percentage of stocks trading above their 50-day moving averages, what I like to call AT50 for above the 50, it actually pulled back sharply, down to 61, let's call it 62%. And now market breadth has basically just been stuck going nowhere for a month. And if we want to stretch it all the way back, we can basically say market breadth has been going essentially nowhere for 4 months. Of course, there's been some excitement in between. And I just don't like the way market breadth is hovering below the overbought threshold at 70%. Per my AT50 trading rules, this is bearish. Now, it's not confirmed bearish, and particularly with the indices just going up and up and up and up, there's nothing to act on the bearish side. But this is why I continue to maintain a neutral short-term trading call. I'm not sure what's going to flush me out of that just yet, but I suspect I'm going to flip bearish before I flip bullish. But of course, we'll just see how time goes. Now, how things go over time. Sorry. So now the cousin for that market breadth is the signal AT50 is the percentage of stocks trading above their 200-day moving averages, what I like to call AT200 for above the 200. And as you can see, it is actually doing much better than AT50 just because while it also has been going nowhere for the past, let's just call it a month, it at least is above where the S&P 500's previous all-time high was back in February. And you can see it looks like it actually is on the verge of breaking out. So I would love to see, no matter what happens with AT50, which is the shorter term health indicator for market breadth, I would love to see AT200 break out at least one more time just to give me just to shave off some of the wariness of my impressions on the stock market. So anyway, so that's the market breadth look. It explains why we have sort of the mixed signals underlying the strong price action. So let's go to the major indices, S&P 500. As you can imagine, like I said in my last video and last post, it has been melting up. The melt up essentially continued this week, despite the small blip we had with the Fed resuming rate cuts. The market did its classic thing where the first reaction is not the final reaction. So, for whatever reason, the market pulled back. There was disappointment that it was a hawkish cut. Um, because there's no real, the Fed, the people who voted, actually, I guess all the Fed governors and presidents combined are just all over the place in terms of their expectations on inflation and the economy, and particularly on the path for rates going forward. So there's no clear dovish signal from the Federal Reserve. And that's the only way I can explain the initial bump down. But the market didn't care at the end of the day, at the end of the week, because buyers just jumped right in. We closed at new all-time highs the next 2 days, and the melt up continues on the S&P 500. Before I continue the chart, just as a quick reminder, please invest and trade using your own risk tolerances and your own time frames. This material I present for educational purposes, but I do appreciate any comments or feedback in the captions below. And then like and share this content so the algorithm knows what's up. And of course, subscribe if you want to get a more timely indicator on when I publish this content. All right, let's go to the NASDAQ. Now, the NASDAQ, same deal as the S&P 500, had that little blip when the Fed issued its rate cut. And then the buyers just stepped in like nothing ever happened, and we continued the melt up to all-time highs. Now, I'm about to get into caveat land again because small caps, IWM, the iShares Russell 2000 ETF, it broke out to an all-time high on Thursday. So people were much more definitive about small caps. You can see actually, let's move that up here. You can see actually that on the Fed day, IWM outperformed the NASDAQ and S&P 500 because it had a decent, well, not a decent, but small 0.3% gain. And then the next day it soared 2.5% to a new all-time high. Ironically, IWM had soared initially on the Fed rate cut to an intraday all-time high. So right now, IWM closed the week with a 0.8% loss and is essentially right at that intraday all-time high. All that to say is that small caps are more sensitive to rate cuts than the S&P 500 and the NASDAQ. So I'm looking at IWM very closely for sentiment. So this is the big caveat, is that IWM could go back into underperformance. But as usual, I am highly vested. I stay highly invested in IWM shares, so I really want to see it continue to go up. Now, why did IWM pull back so hard? Well, I'm glad you asked. Well, because on Friday, and actually you could say starting on Wednesday, long-term interest rates, the Treasury bond, this is the 20 plus year bond, iShares 20 plus year Treasury bond ETF, ticker symbol TLT. It actually did a bearish engulfing. I forgot to label that here, but it did a bearish engulfing in the wake of the Fed rate cuts, which signaled what happened the next 2 days is losses the next 2 days. And now, why would this happen? Well, there's a combination of things. One is that because inflation is still high, these rate cuts could actually definitely aren't going to bring inflation down, but it actually could push inflation up. And if that's what happens, then bond investors are likely going to sell long-term bonds. I'm actually not too clear why bond investors were rallying into the Fed rate cut, given inflation is high. So there's a lot of volatility going on. The general stock market has not cared about what the bond market thinks. But we should care as traders because ultimately the signal in the bonds will rule the day. So on Friday, I believe also there was some strong jobs numbers, which undercut the message that the job market is weak. I think it was those lowest, or actually don't quote me on this, but I think it was the lowest amount of unemployment claims in months, which is a good thing, of course. But the stock market always has mixed emotions about these things because what's good for the economy isn't always good, at least in the short term, for stock traders and in the stock market. Okay, so with that backdrop, we have a general melt up in the stock market. We have the Fed has now got the markets back with rate cuts. Again, assuming that inflation doesn't proceed to go out of control. We have, oh, I almost forgot. We have now more budget drama because budget ceiling drama, which could lead to if everything goes wrong, government shutdown on October 1st. And this is not a politics show, so I'm not going to handicap what may or may happen with a government shutdown. But just suffice to say that with the market up so high, if the government shutdown actually happens, and of course we had so many scares in the past that came to nothing, but if it actually happens now, and we of course have all the material, we have all the fodder for a government shutdown to actually happen, I think we will see a seasonal pullback in October. You know, the classic big pullback in October, which is the last of the most dangerous months of the S&P 500 or the stock market in general. But these are all big ifs. There's nothing to act on until we actually see what happens. There could be some moments, some scary moments going into October 1st as the drama and headlines build on a potential government shutdown. But my best guess is that if we actually get one, the stock market is going to sell off sharply. So that's something just to take into consideration for trades, for timing trades, and for risk management. All right, let's go into a bunch of the stock charts that caught my interest. Let's start with Intel, which of course was the other big news of the day. NVIDIA, thank you, NVIDIA. Here we go. NVIDIA bought $5 billion worth in Intel stock, and they paid only 23.28. So they paid a price that was, commensurate with where Intel had been trading, and the stock market was so excited they granted NVIDIA instant profits. So Intel increased, I think it was up as much as 25, 26% on the day. It closed at a 23% gain. I don't have time to go into it, but I've been writing about Intel. I kept and I actually built a position in Intel. I took this moment as a gift, a welcome gift, because I thought I was going to be sitting in Intel shares for years before any hope of even getting flat, much less making a profit. So I took profits. I sold right at the open. I didn't hesitate, didn't wait. Now, Intel pulled back here 3.2% on Friday as, of course, cooler heads prevail and people are giving a fuller assessment of what this NVIDIA investment in Intel really means and will it actually be the thing that fixes the company? Who knows? I have no guesses on this. I think it's a big positive for Intel. So I may go back to buying Intel shares on the typical technical signals after what's called a calm after the storm happens at some decent support level. I'm looking as a first support level, $29.08 or $29.09, because this was the close on August 2nd, 2024. Actually, let's peel it back so you can see it. When right before Intel dropped 26% post earnings, and that's what put Intel into this 13-month purgatory where it's just trading in this wide range forever. So this breakout, make no mistake about it, is a bullish event. But let's see what happens on the pullback that cools things off. And like I said, I am still willing to buy Intel on good technical signals going forward. Now, this Intel news had a lot of ripple effects. Let's go to NVIDIA, of course. Now, NVIDIA is, let me move this over here. So NVIDIA is still working on invalidating this double top that I mentioned in an earlier video. And you can see now it did break down below the 50-day moving average, but as NVIDIA always often does, it faked out the bears and rebounded right back up. And now it's kind of pivoting around its 50-day moving average. On the news of the buy in Intel, the Nvidia stock also went up, let's see, 3.5%. So, it's always great when you can invest in a company's shares. And not only does that company's shares go way up and give you more value in that investment, but your own shares also go up. This is the kind of stock market we're in where money is just flowing everywhere. And you could do little things, big things, and then just get big gains. So Nvidia definitely benefited on its own stock from this deal. Now, who else benefited? Well, we had Micron Technology benefited. It soared to a new all-time high of 5.5%. I happen to have a call spread, pre-earnings call spread position on Micron that went right into triggered my initial profit target. So now I'm going into earnings for Micron with no position, but I'm going to have my eyes on it because Micron is definitely for this AI era a buy on the dips kind of stock. I also took note that Amcor, AMKR, also had a great day on that news, and it soared 9.5%. I've written about Amcor before. I had accumulated stock, and I was happy to get out with a profit. I think it was maybe a week or two ago. I can't quite remember. So I am looking wistfully at these gains that Amcor continues to put on, but you can see it has a long way to go to fully recover. So if the technicals tell me to do so, I am definitely willing to get back in it. I would prefer to get back into Amcor Technology, ticker symbol AMKR, at the 20-day moving average support and see this nice uptrend on that dash line. Right now, the stock is a little stretched. And then finally, ARM, ticker symbol ARM, ARM Holdings, actually did not do well. In fact, it dropped 4.5% on this news. And I think that's because of the competition uh, between ARM and Intel, or NVIDIA's investment in Intel could take resources away from ARM. I'm not quite sure how the arrows go, but I did take note that ARM had a negative reaction to this news, and it's now below the 50-day moving average once again. And overall, ARM is now also stuck in its own long-term trading range. You can see after this huge excitement way back in February 2024, um, it's had two pops since then that have gone higher than those prices, but overall, ARM is stuck in this trading range, in a wide one at that. But I like to buy ARM on the dips and sell the rallies, so I'm fine with it staying in a uptrend, a well-defined uptrend that's easily tradable. Okay, let's move on from semiconductors to Intuitive Surgical, ticker symbol ISRG. I'm noting this one because just as I feared, Intuitive Surgical is just getting weaker and weaker and weaker. It has been trending down now for 3 months, and it set a new low. Let's see it. It went below the April lows and essentially traded all the way back to a 1 year, sorry, 14-month or so low. So my read on Intuitive Surgical ended up being correct. I'm glad I went ahead and just got out of the stock. But I do continue to keep an eye on it because I do love the company. But unfortunately, both the technical and now it seems like the fundamental winds are not blowing in their direction. I took note of Snowflake, sorry, ticker symbol SNOW, because it, ever since its nice 20.3% post earnings gain last month, it has just been drifting downwards. And you can see here, it held support at the 20-day moving average, just as I would have liked to have seen. I'm a little late on buying Snow, so I'm hoping for at least a tiny pullback come Monday so I can start buying some shares, but I should have bought it on Thursday when it bounced off the 20-day moving average at 1.9%. And then I could have happily said I'm enjoying the entire gain of today, which was 3.8%. Okay, what is next on the list? Let's go to Wix. Wix caught my eye because it had been very bearish for quite some time. Even after August earnings, it continued to sell off hard. And now suddenly the stock market and traders have done a 180-degree turn on sentiment on Wix. This is Wix.com, ticker symbol WIX. So much so that this straight shot up gave a bullish breakout on the 50-day moving average, that red line, and a bullish breakout on the 200-day moving average, that blue line. So now it's right back in bullish position, but I don't want to buy it because you can see that the trading in Wix has just become very erratic. It's right now struggling to get over the last peak. You could see on Friday it actually pulled back. So I'm a little suspicious about the sustainability of this breakout. So I'll just keep an eye on it. I really don't have an opinion one way or the other on trading or fading it. All right, CrowdStrike caught my interest. This is when I really missed out. CrowdStrike was really doing a lot of great signaling last month and early this month on its move into doing AI security, which I think is a great thing for the company. And look at this, just a near picture perfect hold at 200-day moving average support. I really I could have and should have combined the fundamental and the technical news to just buy CrowdStrike, and I would have enjoyed this big surge on Thursday of 12.8%. when CrowdStrike announced the rollout of some AI security product features. So good for them. I'll just continue to keep an eye out for the next dip to buy on CrowdStrike Holdings, ticker symbol CRWD. All right, next on this rare earths type play, Ramaco Resources, ticker symbol METC. This is one, well, I won't tell the long story on this one. Just suffice it to say, I should have already been in this stock as well, but I'm pointing it out because on Thursday it gained 18.7%, which is a great breakout to, I'm not sure if it's an all-time high. Let's go back to the 1 week view. Yes, it is a new all-time high. So this stock is a buy on the dips, and it's an important one strategically for the U.S. Because of its rare earth mining resources. So, and oh, I almost forgot, of course, the government bought a stake in this company. So it's another reason why I'm interested and want to get into it. I think the investment was back in July when this stock soared. Another rare earth mining type company that I mentioned before, but I'm no longer in, is Ucore Rare Metals, ticker symbol UURAF. Had a great day on Friday, soared 19.4%. I didn't actually see any news on this one to explain the big move, but this is another bullish breakout. You can see how nicely it's following the 20-day moving average support and trend line. So I am looking to start getting back in on the next test of 20-day moving average support. I suspect, of course, when I finally get back in, it'll continue to sell off, but I will welcome a continued sell-off because I want to get back into this stock and I'd love to get cheaper prices to do so because this stock has clearly gained favor and who knows, it's a Canadian company, so I doubt the US is going to invest in it, but it is strategically important for North America in general. All right, let's move on to Cracker Barrel. Um, there's some I'll just say a sort of wary, I won't say alarming, but some concerning things that I'm seeing in consumer discretionary stocks outside of the big ones like Tesla. Um, Cracker Barrel, I've written about it. You can check out my blog if you want to see more details on my commentary. Suffice to say that I ended up being correct to say that it was that the signals were saying that Cracker Barrel was going to get weaker after this 200-day, particularly after the 200-day moving average breakdown, but definitely after the failure at 50-day moving average resistance. Google Trends, Google Trends has shown interest in Cracker Barrel has waned very quickly, and you can see here it reported earnings to a 7.6% loss and got a 5% loss as follow through on Friday. So this is all bad for Cracker Barrel. It looks like it's headed now towards its lows from April unless some positive catalyst steps in. You can see the very high trading volume, which says that sellers are definitely in control of Cracker Barrel Old Country Store, ticker symbol CBRL. Also, on the same vein, I did a short actually on Brinker International, which owns Chili's, ticker symbol EAT. Here I'm showing you the stock chart for Darden Restaurants, which owns Olive Garden, and the ticker symbol here is DRI. And this is very important that what happened, it could be a very bad signal for the whole casual dining and restaurant sector of stocks because Darden reported actually headline looked decent. The headline earnings looked decent, but it fell 8%. Let's call it 7.7% post earnings. And then a massive follow through on Friday with a 4.2% drop. I say massive only because the doji, sorry, the candle is all red, all red. And now Darden has pulled back to its April lows, or below the April lows, back to where it was in March. It's broken down below its 200-day moving average for the first time since, well, actually in a year. And this is just an all bearish move on breakdown. I covered my short on EAT on Thursday. Turned out that I could have continued to hold it through at least Friday. So I am completely cautious. Actually, I'm completely wary and concerned about this entire sector now. And so I want to stay away from all of these stocks. In fact, it wasn't on my list to show today, but I want to take a quick look at Jack in the Box. just to see. Oh, look at that. Jack in the Box, ticker symbol JACK, has actually been hanging in there. Look at that. It's consolidating. Now, of course, Jack in the Box, unlike some of these others, has had a really rough go of it. I mean, it peaked in 2021 and essentially has been going down since, and its downtrend accelerated starting in late 2023. So it's possible this stock has finally been beaten up as much as it could be beaten up. Who knows? So I'm glad actually I took a quick detour on this one because I actually have to put Jack in the Box, ticker symbol GACK, actually on my bullish watch list because a bearish to bullish reversal could be on the way. But I will be waiting to see, first of all, 50-day moving average breakout and then a breakout above the last peak before I can really believe in such a reversal. Okay, we're almost there towards the end. Uh, I talked about the jobs report or the jobs picture maybe looking stronger than what people thought. I took note that stocks like Upwork, which is a ticker symbol UPWK, has been very strong since its earnings in August, but it really accelerated after the Fed rate cut 6.1%, and it went up on Thursday another 8.1%, and on Friday it went up 2.4%. So maybe Upwork has finally turned the corner. Let's pull back and you can see that, yes, indeed, it's new highs. It's sort of these higher lows and higher highs, which are good for the stock's prospects. So I want to get back in this one on the next pullback because, as I've written before, I really love this stock. I love this company, but the technicals just didn't allow me to hang in there for too long. I would be taking profits quicker than I expected because the momentum that I expected out of the stock would end too prematurely. But now it looks like Upwork is turning the corner, and so hopefully I can get bullish on this and just stay bullish on this for quite some time. All right, another thing that caught my eye, I didn't even know FactSet Research Systems, ticker symbol FDS, had a publicly traded stock, just like Gartner threw me off with the ticker symbol IT. I didn't realize they were publicly traded. Now, turns out this research and analysis and research company is also publicly traded. And it had a terrible time with earnings. I think it missed, I think it had bad guidance or maybe profits missed. But regardless, who cares? The stock tells it all 10.4% post earnings loss, big follow through the next day to a 4% loss. This took the stock all the way down to where it last traded this low in May of 2020. So this is back to pandemic times. I couldn't resist. I should have been a little bit more patient. I couldn't resist. I did sell a put option, and that put option is already underwater. But I just think that people are overreacting. I think the fear here is that ChatGPT and deep research is going to undermine the business models for these kinds of companies. I subscribe to the free newsletter from FactSet, and they're always providing great stuff. They actually use AI for some of their results and some of their analysis. So maybe people are extrapolating to say that eventually all that stuff could be automated and or it means that the barrier to entry for this kind of work is quickly tumbling. If that's the case, and if I'm wrong that this is just a temporary panic, then there are all sorts of companies that rely on research that are going to be in trouble, including investment banks and other shops that issue um, buy and sell ratings on stocks. So this is something that if you're into the stock market, you should be keeping your eye on and then tabs on. I went ahead and sold just for a tiny profit my holding in Gartner IT, ticker symbol IT. I'll just flip over to the chart really quickly. So I was right about where I seemed to be initially wrong about FactSet. I was right about Gartner, but the rebound is just so slow and so tepid that I decided just to take my meager profits and run. Because you could see, I mean, IT is facing serious overhead headwinds if this rally ever does strengthen. And I figured it also just made sense to swap out of this as given I'm taking a big risk on FactSet's stock. And because of FactSet I decided to do some more looking, and there is another research shop, S&P, S&P Global, and sure enough, you can see when FactSet crashed, S&P Global, ticker symbol SPGI, also fell 6.7%, and now they're in a bearish position below the 200-day moving average. Now, they are still in much better position than Gartner and FactSet. I'm pulling back here. You can see there's still this overall secular uptrend going on, but I consider them to be in trouble. Now, they do a lot more than just issue research, but you could believe that people are going to be scrutinizing their earnings very closely. And now SPGI is trading below where it was right before it had this nice 4.1% post earnings gain. All right. Well, thanks for sticking in with me. I know I went through a little slowly and methodically on some of this stuff, but we are in this incredible season. We're almost finished with the second of the third most dangerous months of the stock market. The month started off just like August with a big sell-off, and then buyers stepped in and just took things off. So if we get a government shutdown and the stock market sells off to begin October, I just can't believe that for a third time buyers will just step right in, just like they did in August and September. Of course, it's possible, but it just seems to defy all the odds. We will see, as always. Stay on your toes, traders, investors. We are probably in for some rough and tumble trading before we then glide into what's the seasonally strong period for the stock market, which will begin in November. All right. Thanks again for hanging in there. I'm Dr. Drew with Ahan Analytics, showing you the market breadth, and I will check you out later. Take care.